Hello, this is Bennett Tchaikovsky, and welcome tonight to Non-Cash Exchanges. A disclaimer and copyright notice: the information and opinions in this presentation are those of the author only, and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2019 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So welcome. And tonight we're going to be talking about more of an intermediate accounting type topic, or non-cash exchanges. Just a few words really quickly. One of the reasons why I don't do a lot of intermediate accounting videos, well, one of them is because of time, but the other one is that the book that I really like to use, which is the Keystone Weingart, I've been using it for the last 4 years. A lot of the book publishers are really kind of, I don't want to say it crazy, but if I were to start making videos going over their questions, you know, their reps have kind of told me that no, don't do it. So this is something I've created on my own. It just takes a little bit longer to go through and do it. I have used a few different attributions, which I will give as I go through and do this presentation. So the first thing I want to review with you is right over here is what happens when we dispose of an asset. And this is something that's really important to remember, is because this kind of goes back to financial accounting, is that when we sell equipment or dispose of it, there's a few things that I have to go through and do. And this is a journal entry that if you need to memorize one, this is one that I would memorize. So right here, I've got to take that old equipment off of my books. And I also have to take the accumulated depreciation off of the books as well. Remember, the equipment will have a debit balance because it's an asset. The accumulated depreciation will have a credit balance because this is a contra asset account. Then over here, I'm receiving cash, and then my balancing or my plug is going to be whatever I need to do to balance this particular equation. So over here, let's go ahead and look at an example. If a company sells equipment for $5,000 cash that had a cost of $50,000 and accumulated depreciation of $41,000 on December 1st, 2019, and assuming that all depreciation had been taken up to the date of sale, what would the journal entry be to record this transaction? And again, we're going back here, and if you memorize this transaction, here, the equipment cost me $50,000. I have to take it off my books. I'm crediting that equipment for $50,000. It had accumulated depreciation of $41,000. Have to take that off my books. Okay. Now, sometimes I would give my students a question that would be, oh, well, I bought it on June 1st, 2014, and it had a 10-year life, and I would be using straight line. That's not the case here. I'm giving you this balance. Then I'm receiving cash, right? I sold equipment for $5,000 cash, so I'm debiting cash. And when I look at this balance here, right, I've got $41,000 of debits, $5,000 of also debits here for the cash, and I have $50,000 of credits. What I'm doing here, though, is I need to balance, right? And so I need to balance here with a debit of $4,000. The reason why I also like to use this form of journal entry for basically when I'm selling something is oftentimes you'll see the book. The book will say, oh, you've got equipment of 50 and AD of 41, and therefore you have the book value is 9,000. You compare that 9,000 book value to the cash. Well, if that book value is greater than the cash received, then you have a loss. That's way too confusing. If you do this in a journal entry, it's generally going to work out because whatever you need here, if I have to balance with a debit, I have a loss, right? If I balance over here with a credit, I'm going to have a gain. So this is going to become really important for this next area that we're looking at. And even though it's not a part of a non-cash exchange, this is really the foundation for which I'm going to be giving you and teaching you non-cash exchanges today. So What exactly is a non-cash exchange? Well, I'm exchanging equipment for equipment. And when I'm doing that, the most important thing to remember is I have to take the old asset off of my books. And the way we're going to go through and do this is I'm going to be debiting the accumulated depreciation on the old equipment, and I'm going to be crediting the equipment over here. I've got to take that old equipment on my books. I'm going to be receiving something new, which will be with a debit. So now this is kind of a chart here is in terms of what happens when we're in if we have a gain or a loss, right? What do? When we're looking at transactions, there's three different ones that we're looking at here. There's transactions that have commercial substance, which generally these questions will tell you that, yeah, the transaction has commercial substance. Then you have transactions that are without commercial substance where no cash is received. And then you have transactions that are without commercial substance where some cash is received. When we look at this over here, if you look at this column right over here, it says recognize losses. We will always recognize losses. It does not matter what situation we're in here. However, when it comes to gains, this is where it's different. When we have gains, it depends on where are we with regards to commercial substance, without commercial substance, no cash, or without commercial substance with some cash being received. So let's go through what exactly does commercial substance mean. It means that if more than 25% of the total assets that are received in cash, the transaction is deemed to have commercial substance and the gains are fully recognized. Generally, we'll be telling you if the transaction has commercial substance or it does not. This is a link right over here for simple studies or accounting made simple. And if you take a look right over here at that link, and I'll put this link below into the YouTube video, but this is when it kind of talks about right over here, if an exchange has no commercial substance, and it kind of goes through and talks about this right over here. But again, this is the key right here. If the cash is more than 25% of the total assets received, the exchange is treated as a cash sale, and the entire difference between the fair value and the carrying amount of the old asset book is as an income statement gain. Okay, so going back over here, okay, so let's take a look here at our first example. Okay, so anytime there's a loss, we're going to recognize that loss immediately, whether or not cash is being paid or received. So Lee Lifeson Inc. exchanges equipment with an original cost of $100,000 and accumulated depreciation of $45,000 for new equipment with a fair market value of $35,000 and $5,000 cash. So we're giving up old equipment, and now we are receiving new equipment with a fair market value and $5,000 cash. So how do we go through and do this journal entry? So let's go ahead over here and take a look at our Google Sheet, my favorite tool for teaching. And if I look at this over here in terms of my Google Sheet, so we've got Lee Lifeson here, exchanges equipment with an original cost of $100,000 and AD of $45,000 for new equipment with a fair value of $35,000. Prepare the journal entry to record the transaction. Let's make this a little bit neater. And so right over here, there we go. So my first step over here is going to be, what is my journal entry? And remember, going back to what we were doing before, whenever I would basically dispose of an asset, if I have a debit over here, I need a loss, cash, accumulated depreciation on the old equipment. Here, though, I'm recording the new equipment that I'm receiving. I have my old equipment that I'm taking off my books, and if I need a credit to balance, it will be a gain. So right over here, I'm receiving cash of $5,000. I'm also taking the old accumulated depreciation off the books of $45,000. I'm receiving new equipment with a fair market value of $35,000, and I'm taking old equipment that had an original cost of $100,000 off of my books. So the way I want to go through and do this is that right over here, I'm going to total up my debits. which is going to be the 5 plus the 45 plus the 35. I'm going to total up my credits. Am I imbalanced? No, I am not balanced. Therefore, what I need to do is right here is I need another debit for 15,000. Once I have this debit for 15,000, I'm going to be going through right over here and I will be balanced. So I'm going to add up these 4 items here and I'm at $100,000. So because I'm in a loss situation, it does not matter whether I'm paying cash, I'm receiving cash, I'm always going to recognize losses. That's a very, very important thing in non-cash exchanges. Do we recognize losses? Always. So no matter what we're in, commercial substance, without commercial substance, some cash received, without commercial substance, no cash received, we always recognize losses. Okay, now taking a look at the next one over here. Again, commercial substance. We're going to fully recognize our gains. Again, the problem will tell you, does this transaction have commercial substance? Or is the cash consideration greater than 25% of the greater of the total transaction? So when we have a non-cash transaction with commercial substance and there's a gain, we're going to fully recognize this gain because the transaction has commercial substance. So here we have Peart Inc. exchanges equipment with an original cost of $80,000 and accumulated depreciation of $60,000 for new equipment with a fair value of $15,000 and $12,000 cash. Okay, so what it's asking us to do here is to prepare the journal entry for Peart Inc. So what I'm going to do is over here, I'm going to go back over to my Google Sheet. And if you like the references, this is from one of my favorite bands growing up, which is Rush. Huge Rush fan. I've been to a lot of their concerts. A great, great show. So make sure you go. But actually, it's too late now because they're done. But if they ever come back again, you got to go. So right over here, I'm exchanging equipment with an original cost of $80,000. Right. So I'm going to put my debits here, my credits here. So this equipment originally cost me $80,000. Okay, and it had accumulated depreciation of $60,000. Okay, so and I'm receiving new equipment with a fair value of $15,000 and cash of $12,000. So as I look at this right here, the transaction tells me that there is commercial substance to this transaction. So therefore, I'm going to go through and recognize the gain. But in any event, why do I know that I'm in a gain situation? Well, I received cash, and when I take off that old accumulated depreciation, and I add in the fair value of the new equipment being received, I have total debits of $87,000. Over here, I have total credits of $80,000. Again, right over here, what I like to do is by using this journal entry, I can kind of see where I am. So in this case right over here, what do I need to do to balance? Well, I need a gain of $7,000. And because I'm in a situation where the transaction does have commercial substance, I'm going to fully recognize the gain. It's the key part here, right? If the transaction has commercial substance, I fully recognize the gain. Okay. So let's go back over here and to our next one. So our next one over here is a situation where we have a gain, but there's no commercial substance and there's no cash received. If there's no commercial substance and there's no cash received, we're going to fully defer the gain by adjusting the fair value of the new asset received. Okay, so this is really important. Again, if the transaction does not have commercial substance, we're going to fully defer the gain. How do we defer it? We're going to reduce the carrying value of that new asset received, and we'll kind of explore why this is. So here we have Rutsey, which was the original drummer for Rush, exchanges equipment with an original cost of $90,000 and accumulated depreciation of $50,000 for new equipment with a fair value of $77,000. Okay, so right over here, let's look at our next example. So here we've got Rutsey Inc. And let's go make this a little bit bigger. Okay, perfect. Okay, so the first step we're gonna do, and again, what zone are we in? We're in a basically over here, we're doing a transaction that does not have commercial substance and no cash is being received. So we're gonna defer the gain. So the first thing I'm gonna do is I'm gonna figure out, am I in a gain or a loss situation? So here, no cash is being received. The accumulated depreciation on the old equipment was $50,000. Okay, how did I know that? Because the problem is telling me so, okay? Also, the problem tells me that the equipment, the old balance, was basically a value here of $90,000. So what do I need? What am I also receiving? I'm receiving over here new equipment with a fair value of $77,000. So am I in a gain or a loss situation? Well, I'm going to go ahead and add up these three values here. There's no cash being received. I compare that to the old equipment over here. And sure enough, what do I need to do to balance? Well, over here, I'm going to need a $37,000 credit in order to balance, right? So this is my balancing entry. So right over here, this is my balancing entry. Now, the problem is that over here, when I'm in this situation, the transaction has no commercial substance, no cash is being received, I have to defer it. So even though I have a gain per this calculator, I have to defer it. Now, when I'm going through to defer it, how do I do it? No matter what I do, I have to take the carrying value of that old equipment off my books. Remember, the whole thing is when we're dealing with non-cash exchanges is I have to take the old thing off my books. So what's going to end up happening is that new equipment is going to say, well, if I'm deferring the gain, then how much do I record the new equipment for? It's going to be whatever I need to do in order to balance this transaction. So my new equipment right over here is going to have a journal entry, or basically it's going to be whatever I need to do to balance the entry, which in this case right over here will be a debit of $40,000. Notice here, I'm not doing dates, I'm not doing descriptions. Those wouldn't be normal things that you would go through and do. So again, I'm going to use this journal entry to determine what my gain should be. Now, because I'm going through and I'm in a non-cash or I'm not in a commercial substance or the transaction lacks it, I'm going to go through and defer that gain. So my first step is here is we're really going to go through here, prepare the journal entry, and determine if we are in a gain or a loss. Okay. So in this case right here, as we're going through and doing this particular one, this is how we're going through and doing it. So we're in a gain, but it's not, the transaction lacks commercial substance. Therefore, we defer it. How do we defer it? We defer it by reducing the carrying value of the new equipment. Why does that make sense? I can't touch this. Once this equipment is going off my books, I'm getting rid of it. I'm crediting equipment, the old stuff for 90, debiting the old equipment here for the accumulated depreciation, and this is what I'm left with. So that's what I'm adjusting. Okay. So right over here, and for our very last example. So our final scenario right here is going to be a transaction that is without commercial substance, but some cash is being received. So when we see this right here, right, so it has, the gain has no commercial substance. We're in a no commercial substance situation. Some cash is received. We're going to be recognizing part of the gain. How do we do this type of question? So when we have this is by far the hardest one, okay, is that when we have a non-cash transaction with no commercial substance, some cash is received, and if there is a gain, we're going to only recognize part of the gain. And the way we're going to do it is we're going to say, okay, the first thing we do is we determine the total amount of the gain, which is by using that journal entry. Okay, that's going to be the first thing we do. Then what we're going to do is we're going to learn how to do formatting on slides, because clearly Tchaikovsky is not an expert at this. Let's go ahead and let me fix this real quick. Hold on. Wow, the thing is magically fixed. So what I'm going to do first is I'm going to determine the amount of the total gain by using that original equation. Then what I'm going to do is I'm going to recognize part of that gain by using an equation. I'm going to take the cash received, or the boot, right? And I'm going to divide that by the cash received plus, and that actually should not be a times, it should be a plus. There we go. How many more errors can I have on a presentation? I have no idea. We're just getting started. So I'm taking my cash received, or the boot. I'm dividing it by that cash received plus the fair value of other assets received. I'm going to multiply this by the gain, the total amount of the gain, and that's going to tell me over here the amount of the gain I'm going to be. So right over here, I'm going to multiply that by the gain that I had up from up here, and this is going to tell me the amount of the gain that I recognize. It's not going to be the full gain. It's going to be a partial gain. Then what I'm going to do is that this will be the gain that I recognize. And then the way I'm going to defer the rest of it is I'm going to reduce the carrying value of that new asset received, or that new equipment that's been received. Let's go ahead and take a look at our Google Sheet. We're not quite ready to say goodbye, so we're not a Ouija board. We're right over here. Okay, so we've got Tor By, or ByTor, great album, or off of that Fly By Night. So the first thing I'm going to go through and do is I'm going to compute the total amount of the gain. The way I'm going to compute the total amount of the gain is by our standard equation that we've already been going through and using. When I have this here, what I'm going to do is I'm going to say loss, balancing, cash, accumulated depreciation on the equipment, new equipment. I have to take that old equipment off of my books, and then I'm going to have a gain balancing. So here, so the equipment originally cost me, $200,000. Okay, so this equipment cost me $200,000. And then over here, it had accumulated depreciation of $150,000. Okay, I'm receiving new equipment with a fair value of 80 and cash of 10,000. Okay, and I just put this in the wrong place. The equipment old is 200. My gain, or my balancing amount here, is going to be, so we've got cash being received of 10,000. I had to take the old accumulated depreciation off of my books. I also have to receive this new equipment. And then over here, I'm taking that old equipment off my books. Notice here, this is not my journal entry. I'm just doing this because it's easier for me to figure out what's going on by looking at the journal entry. So I'm right here, I'm at 240, credit over here for 200. So my total gain, right, before I'm going to go through and defer anything, is going to be over here for $40,000. Okay. So this is my balancing entry, is my gain. So this is not my journal entry because I can't recognize the full amount of the gain. So what do I do next? The next step I'm going to be doing here is going to be saying, okay, how much of this gain am I actually going to be going through and recognizing? So the amount of the gain to go through and recognize is we're going to use this ratio, or the cash received, or the boot, of 10,000, and I'm going to divide this by 10,000 plus the fair market value of the assets being received, which is going to be 80,000. So when I go through, and I really should have changed that to 90, but it's okay. So right over here, I'm going to have 10,000 divided by 90,000. So what I'm going to then do is I'm going to multiply this 10,000 divided by 90,000, or 1/9. I'm then going to multiply this by my total gain. The amount of gain that I'm going to be recognizing is going to be 40,000 times 10,000 divided by 90,000, or 4,444. So fortunately for me, this wasn't 6,666, or then I would be looked as purely satanic. Okay, so the last part that I do here, so this is telling me the amount of the gain I should be recognizing. So what I'm going to do now is I'm now going to go through and revise my equation here, okay? So the amount of the gain that I'm actually going to be going through and basically recording is going to be 4,444. Now let's make this nice and bigger. You can see how amazing my Excel skills are. LOL. Hashtag Tchaikovsky needs to take an Excel class. So over here, I'm still need to take that equipment off my books of 200,000. The old accumulated depreciation on that equipment, remember, I can't change that. Okay, however, in terms of the new equipment, right, what am I going to be recording this at here? So it's going to be the difference between these two here, or 54,444, okay? And if I add these up here, I get 204,444. Okay, so this is how it works. I recognize part of the gain, and then what I'm going to be doing is I'm going to be reducing the carrying value of that new equipment. How do we know that this looks right? Well, if I look over here, the total gain was 40,000. Once again, let's make this a little bit bigger. Okay, my total gain is 40,000. The gain recognized was 44,444. So my deferred gain is going to be over here at 35,556. So the amount of the carrying value of my new asset is going to be my old carrying, or my basically the fair value was $80,000 less my deferred gain, which is 35,556. My new equipment carrying value, or my initial carrying value, is going to be, where did I screw that up? Oh, I forgot over here, I got cash as well. Tchaikovsky, there you go. Okay, so this should be 44,444. This is why we always work through our questions. Okay, what did I do wrong there? Well, when I was doing this final journal entry right over here, I forgot to bring the cash being received down. So let's walk through and do this one again real quickly. So the first thing I do is I compute the total gain. How do I figure out my total gain? I'm using my disposal equation. Whatever I need to do to balance, if I need a debit, I'm at a loss. If I need a credit, I'm at a gain. Because this transaction lacks commercial substance and some cash is being received, I'm going to be recognizing part of this gain, not the full amount of the gain. So right over here in step 2, the way I'm going to determine to recognize this gain here, or part of it, is going to be the cash received, or 10,000, divided by the cash received plus the fair value of the assets received, or that new equipment. So this here is going to give me 10,000 divided by 90 times 40,000, which will give me 44,444. This is going to be the amount of the gain that I recognize. So what I do here is I come down And I'm going to basically say, okay, I received cash. I needed to get rid of that accumulated depreciation. My old equipment here at a balance of 200. My gain to balance, right? This is the amount of the gain that I'm recognizing. So over here, I've got a total over here of 10,000 plus 150, and I've got 200,000 plus 4,444. What do I need to do the balance? Well, this is going to be the new balance of my equipment, or 44,444. So when I add up these three items here, I'm in balance. So how do I know if I've done this correctly? Let's come over here. My total gain was $40,000. Okay. However, right, my gain recognized is only going to be 4,444. So my deferred gain on this equipment is going to be 35,556. So if I look at this here, my fair value is going to be 80,000. That's what the equipment I received. I reduced the fair value by the amount of that deferred gain. So over here, I've got a fair value of 80,000 less my deferred gain of 35,556 gives me a new equipment carrying value of 44,444. But of course, as I go through and look at this, did I need to go through and do this whole calculation here? Well, thank goodness I did it, because I was able to see that I made a mistake. But what I could do is I just say, okay, here's my new gain, here's the old equipment, here's the cash, here's the AD. This is going to be the carrying value of my new equipment. So again, this has been non-cash exchanges. I want to thank you for joining me here tonight, tomorrow, or wherever you might be. Please do not forget to like and subscribe. That helps out immensely. And then a few other things too is that if you have a video that you would like me to do and you post up a question, I can hopefully create something for you, or I might have other materials that you can also be using as well. So again, thank you for joining me for this presentation on non-cash exchanges, and I'll see you on the next video. Have a great one.